presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compact Market Wrap weekly YouTube update for April the 28th, 2025. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. Again, don't forget to subscribe to this channel. All you have to do is click on the subscribe button, so whenever I do an update, you will be notified and you can watch it at your convenience. Looking at the numbers last week, great week in the markets, up 4.6% for the S&P. Dow was up 2.52, NASDAQ up 6.73. Year to date now, the S&P is down 5.68%. If you have a balanced portfolio, you're down 2-3% or so, or plus or minus, so it's not the end of the world after two fabulous years that we've had in the markets, as long as you had the right balance in your portfolio. If you're down 20, 30, 40%, you have a problem, and you know it. You made a lot of money, you gave back a lot of that money, and you've heard me say this for 30, 40 years now. It's not what you make, it's what you keep that counts. Having that balance, trying to make that quick money, you make it quick, you lose it quick, easy come, easy go. That's not what you want to build that over a period of time. That compounding adds up over a period of time very nicely. So if you had the right built-in portfolio, the shock absorbers in your portfolio, it hasn't been pleasant over the last couple of months since the February high. We're down about 10% from the highs. If you're down 5-6% from the highs in your portfolio in the market, that's the price you pay for being in the stock market. That's why we get the returns that we get in the stock market. It's being able to handle the volatility and not panicking. That's what pays in the long term. Last week, the best sector was technology. Again, the big, all the stuff that was down big over the last couple of months bounced up big. Consumer staples still suffering. People are still worried about the recession. I don't know. The chances of recession have gone up, but if we somehow get some clarity on tariffs, a rollback, I don't think they'll go back to pre-April 2nd, Liberation Day, but I think we'll get tariffs somewhere. We get some negotiations, we get some agreements with China, we get some agreements with Europe, and something moving forward. We haven't seen any agreements yet. You hear about people flying in, team is flying in, this team flying out, we're talking, this phone is ringing, that phone is ringing. We need some concrete clarification. That's what we need on the tariffs. Once we get that, I think the next big thing will be taxes. How does the tax bill, they'll put out something that'll scare a lot of people. Oh my God, this is going to be too much tax cut, not enough spending cuts, deficit is going to go up. That's going to make people nervous. So that'll be the first. Then people say, wait a minute, that's too much. So then we'll get something cutting back. And that's how we'll get some bill passed through Congress. And I think it won't be as extreme as some people are worried about. We'll get some agreements. And if we get some tax cuts and some spending cuts at the same time, I think that will be positive. If we just get tax cuts and not enough spending cuts, that would be sort of negative for the market. So how does that go over the next couple of months? I think tariff anxiety is going to subside, and the tax anxiety is going to be the forefront of what is going on in Washington and what are they going to do with taxes. Once we get that by the end of the next couple of 2-3 months, we get some clarity on tariffs, some clarity on the tax bill. Once we get those two clarified, I think we'll have a clear path for the stock market to figure out where we go. And as the chances of a recession go down, the chances of the economy sort of holding its own, that will sort of give clarity moving forward. And then we can figure out what companies are doing well, what companies are not, where the profits are going to be, and figure out all of that. But for right now, being a little bit cautious, being a little bit conservative, not trying to swing for the fences is the answer. That's what you have to do. Looking at oil, it's still $10 below where it started last year, started the year. So oil has come down. That should bring gasoline prices down. And housing is another sector where I think it is going to slow down also, and I'll show you a chart in a minute. Whereas housing slows down, I think that brings the shelter part of inflation down, which is a big part of the CPI, the Consumer Price Index, or the inflation number. So that will continue to come down, and that should give the Fed some more leeway over the next couple of months once they get some clarity on tariffs, some clarity on taxes, to start bringing interest rates down to support the economy. Interest rates, talking about those, down from 4.34 to 4.29. Today we're at 4.22. So we've sort of come back down a little bit on rates, which is good. We had popped up to 4.5 when we had the bond market throw a tantrum, worried about all the tariffs. Now we've sort of seen tariffs back off a little bit. And this is the housing number. The number that we see is about 7 months of supply of houses, inventory to sales. When we get about 7 months supply, that's where the market is in balance. When we get above that, that's when prices go down. You can see Florida is not doing well in real estate. They've got too much supply now and on the market. They've got Cape Coral is down to 15 months of supply, so that would definitely hurt. You're looking at the Midwest, that is all in green right now, 2 to 3 months of supply, so that's a tight market. Looking at some of the other areas, Los Angeles, we're about in balance now. The prices, I think, are going to stabilize here. Arizona is a little bit higher. We could see prices weaken there a little bit, but this gives you an idea. If housing prices come down, shelter prices come down, rents come down. Rents come down, inflation comes down. Inflation comes down, the Fed can cut rates. So I think this, again, is a longer-term picture. And the biggest problems you see when we have big recessions like we had, the Great Recession, because of a housing problem. We don't have a housing problem right now. So, and we don't have a banking crisis. Those are the two things that create big recessions or problems. We don't have that yet. Market, we get the PMI last week, it dropped to 51.4. 51.2, still above 50, so we're expanding. The big number we get this week is on Wednesday, where we get the first quarter GDP. It was at 2.4% in the previous quarter. It is expected to be right around 0.3%. So a big drop from 2.4 down to 0.3. That is a big slowdown in the economy. I think that is because a lot of companies were not sure. As we get some clarity, we'll start going up there. Looking at then, we get initial claims for unemployment. They come out on Friday. Unemployment is expected to stay stable around 4.2%. That's what it is. And then we get the non-farm payroll. It was 228,000 last month. Those are jobs created. The estimates right now are around 133,000 jobs. So as long as we're somewhere, we don't see a spike in unemployment, we will see a slowdown in GDP. That'll bring, again, the recession people coming out. Oh my God, the recession is here. Yes, we have seen a marked slowdown in the GDP, but we'll have to wait and see how long lasting it is. It is because of the terrorist tantrum. That's why we saw a slowdown. People just are not sure what to do. And until we get clarity, we'll continue to go through that. Looking at the technicals, we're stuck between this red line, which is the 20-day moving average, and the 50-day moving average, which is the blue line right here. Market is these vertical lines that you see are the market. We're trading around 5,500 today. This is 5,400, 5,415. This is 5,600. We're right in the middle today, around 5,500 is where we are. So I think we're going to continue to go back and forth for a period of time. We have come back up. We've got ABC now. Instead of a 5 wave, this could be B. And then we could see a C wave, again back down. So bouncing around here, that's what we are going to get for the next couple of months in the market. That's the way I'm looking at it. You look at a bigger chart going back a few years, where each one of these vertical green and red lines is 1 week of trading, going back to 2021 all the way down here. This is the 2021 to 22 low right here. October 2022 or 23, and there 22, and that's where we went up from there. We went in wave 3 to the upside, wave 4 to the downside. Then we should start, but wave 4s are choppy. They'll go back and forth, up and down. And that's where we're in, wave 4. This was the first down. Now we're getting up. We could bounce around. So if you see a broader range, 5,200 to 5,700, that's a bigger range because this is a longer term chart. And that's where I think we're going to bounce around for a period of time until we get clarity. NASDAQ, again, looks like we made a fifth wave bottom, bounced up from there, 16.8, 17.6. Those are the ranges that I'm looking at. And again, some bounce around here. Weeklies are still negative. We saw the third wave high, fourth wave decline. Now we start the fifth wave, but it takes time to develop this. And again, fourth wave's choppy. You've heard me say that. Up and down. We came down, come back up. It could come down a little bit, bounce up again, and that's what we're going to get over the next couple of months. Yields had bounced, went up to nearly 6 a couple of weeks ago, and now we're down to 4.22 today, right at this magenta line, which is the 200-day average yield in the market. So we're right there now. It's coming back down. Gold looks like we've made a short-term top. 3,200 is the 20-day, 33,050 is the 50-day. Again, if we get some pullback here, down to 3,000, maybe even a little bit lower, could be a good place to add gold if you don't have. But don't go out and buy all the gold. We talked about this in a lot more detail in the podcast today. So tune into that. You can download the app simply by going to the App Store and typing in Market Wrap with Mo Ansari. One word, Market Wrap with Mo Ansari. Download the app. Whenever I post, Javed and I talked about this in a lot more detail about gold today on the podcast. You can see that and hear that. Again, if you want to subscribe to this channel, click on it and you'll get these updates whenever I do them. If you want our help in your portfolio, this is a great time to rebalance. If you were nervous at 4,800, now the market has come back up to 5,500. Now is the time to rebalance. If you were uncomfortable then with the market, now is the time. Oh, well, it's going up now. Now I don't want to do anything. Then it goes down. Oh my God, I'm panicking. Don't do that. Do it now. Get the right balance. Send us an email at invest@compact.com or just call us at 800-388-9700. Those are my views. Those are my thoughts this week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.